What's up everyone, it's Caddy with MoneyVest. So in this video, we are going to be talking about the FOMC meeting that is going to be happening next week on Wednesday. So I will be breaking down everything you need to know. We're going to take a look at the summary of economic projections. We'll also talk a little bit about what Chairman Jerome Powell has said previously in the previous FOMC meetings and what is the expectation and my predictions for how the markets might respond to everything that could happen on Wednesday when the summary of economic projections is also going to be released. So as always, if you enjoyed this video and find it helpful, make sure that you drop a like and don't forget to subscribe to the channel. Links to our Discord and Patreon is going to be down below if you're interested in joining us and of course getting access to all the members only private videos. And again, that 16% annual discount to our MoneyVest community. It's going to be linked down below with a few more spots left for the month of March 2024. So 3 more days left for the next FOMC meeting, and this right here is going to be the expectations from interest rates when it comes to the market. So this is the market's expectation for interest rates. 3 rate cuts is what the market is pricing in. We've been kind of fluctuating between 3 and 4 rate cuts in the past from FOMC meetings, from Jerome Powell's speech and testimonies in front of Congress. We've learned that unanimously there's a majority of members on board with some type of rate cuts in 2024. But the 2 uncertain things with respect to interest rates are when will they begin and how many rate cuts are going to happen in 2024. So the frequency of those rate cuts and the amount of rate cuts are still under question mark, but that they are coming is somewhat certain because what Jerome Powell has already mentioned. Now, I do want to go over this in this video because this is a very, very important type of analysis. And what you'll notice and what I've tried to explain in my previous videos is that for the Federal Reserve, the risk of cutting too early is significantly more than the risk of cutting too late. In other words, the risk of cutting too early far outweighs the risk of cutting too late. And the reason for that is, once again, very simple. It is much easier for the Federal Reserve to deal with a recession than it is to deal with high levels of inflation. Because a recession and unemployment can be dealt with by lowering interest rates really, really quickly. But high levels of inflation cannot be dealt with very quickly. It has to be a long duration process, as we've already seen, because the Federal Reserve has been raising interest rates for the last 2 years. It's not like we woke up one day and we got to this 5% level on the federal funds rate. Nope, this has been a process of 20 to 24 months of consistently increasing interest rates, in some cases doing these jumbo hikes of 75 basis points to get to where we are. So it's a long process, and the last thing the Federal Reserve wants to do is restart that process if inflation starts to reaccelerate back higher. And that's exactly what happened in 1970s and 1980s, and what you'll notice on this chart is essentially that. So again, we've got the unemployment in green, we've got the federal funds rate in blue, and we've got the inflation in red. And what you'll notice is that every time we saw interest rates go down, so every time we saw that interest rates were selling off, or basically the Federal Reserve decided that, okay, let's bring interest rates down, we saw a subsequent increase in inflation, right? So inflation increased here, inflation increased over here as well. And both times we had interest rates lowered in expectations that they can be lowered because inflation's back down. But little did they know back in 1970s and 80s that they were doing it too early, and that resulted in inflation reaccelerating back higher. And every time they had to increase interest rates higher than the previous time because inflation itself was going higher than the previous time. And as a result, unemployment also increased. So the green line, you'll notice, peaks later than the blue line or the red line, and that is to say unemployment goes up after interest rates go up because it takes time for higher interest rates to play a bigger and bigger role in the overall economy. That's exactly why the Federal Reserve is going to be very, very cautious with respect to lowering interest rates because they need an incentive. So at the end of the day, they really need a reason to cut interest rates. This is where we are with respect to interest rates. So we are higher, of course. Inflation has been trending lower, but it's really just been stabilizing a little bit. As you can see, we've really just been going sideways, and unemployment also has been pretty much sideways. That's the green line you see on the chart here, as it has continued to come down from those levels. So the risk of cutting too early is far greater than the risk of cutting too late. And that simply means that, let's say that interest rates start getting cut here. Well, that's going to be a problem potentially if inflation starts to reaccelerate back higher. So that's not what they want to see. They really want to see more, greater confidence that inflation is indeed coming down. It's coming down to the target of 2% or lower. And that's what's going to give the Federal Reserve more data, more confidence that they can indeed cut interest rates finally and help support the economy. Now, this right here is where we are with the dual mandate. So dual mandate is essentially the two policy goals that have been set forth by Congress for the Federal Reserve. So this right here is where we are for the dual mandate, which is to say that, okay, we are a little bit close to 4% level now after the unemployment report that we got on the first Friday of this month. And we are also, of course, higher on inflation because we're well over 2.5%, closer to 3% right now on core inflation. So this is where we are. And this is really where the Federal Reserve wants to go, right? So the Federal Reserve wants to basically come down to this level of, 4% unemployment and about 2% inflation. That's their target. This is where the Federal Reserve is hoping to get down to eventually as interest rates continue to stay higher. They're hoping that inflation is going to come down and unemployment is going to stay where it is or perhaps go up to 4, maybe 4.2%. In other words, it is going to be creating a soft landing scenario. Now, there is possibility that instead of coming straight down, we basically go here, we basically go down, we basically go this way, we go back. I mean, there's a lot of different possibilities, right? This is really all the different scenarios that could be happening for the economy, for the markets with respect to interest rates and unemployment. Now, if interest rates continue to stay higher for longer, which is what we have seen over the last several months here, it's possible that unemployment definitely increases. So one most certain probability is that unemployment is going to increase. But the real question once again becomes, is inflation going to come down fast enough before unemployment starts to go up? That's another thing the Federal Reserve is really banking on, is the idea that by the time unemployment starts going up, inflation's going to be back down. So the rate of decrease in inflation is going to be faster than the rate of increase in unemployment. That's what they're really betting on, is what I just said. Okay, they're really hoping that by the time unemployment really starts moving higher and higher on the back of these higher interest rates, inflation is back down to their target, perhaps even lower, so that they can finally help support the economy. They can bring unemployment back down by cutting interest rates and start their quantitative easing process. The last thing they want and the last place they want to be at is a place where both unemployment and inflation is higher than what their dual mandates suggest. So basically going from over here to this top right quadrant would be the worst thing for the Federal Reserve, because in this scenario, not only is the unemployment higher, but inflation's higher as well. And then they have to kind of go against their dual mandate. What do? Do they support inflation, or do they support the economy? Do they fight the recession, or do they fight high inflation? That's going to be the real question, and nobody really has the answer to that scenario at the moment. So this right here is the meeting, March 19th and 20th. So March 20th is when the FOMC speech is, Chairman Jerome Powell's speech at 2:30 p.m. Eastern. And the asterisk basically represents that there is going to be a summary of economic projections accompanied with this FOMC meeting. And you'll notice that in the past, in the previous report from back in December, so December was the last time the summary of economic projections were released, for 2024, the Federal Reserve was basically pricing in 4 rate cuts. 4 rate cuts. Actually, is that 4? That's 7. That's 3. 3 rate cuts, because the Federal Reserve was pricing in 75 basis points, right? So 4.6 and 5.4, that's about 80 basis points. 80 basis points is roughly about 3 rate cuts for 25 basis points each. So that's about 75 to 80 basis points. So 3 rate cuts is what the Federal Reserve FOMC was penciling in to their summary of economic projections for 2024. And 3 rate cuts is exactly what the Federal Reserve is what the market is also pricing in, is what the market is also expecting for 2024. Now, coming over to my expectations from the markets for this upcoming week and what could potentially happen. So I've broken it down into rate decision and the guidance for 2024, which is going to be in their summary of economic projections. So if we do see a rate hike, right? So if we see a rate hike in this upcoming meeting, that will be very, very unexpected, and that will be very, very bearish for the market. There's a 0% probability that that's going to happen. So basically no chance the Federal Reserve hikes in this upcoming meeting. So we can kind of disregard that, but I just wanted to put it out there anyway, that if it happens, it's going to be very unexpected and very bearish. Now, if there's no hike, that's exactly what the market is pricing in, exactly what the market is expecting. That could perhaps be neutral, because 98% probability is that the Federal Reserve is going to do nothing and keep interest rates where they are. It's already expected. It's already expected to happen. So neutral reaction from the market. If we surprisingly get a rate cut, that is unexpected. Again, very, very low probability. We're talking 2% probability for a potential rate cut here. That will, of course, be very bullish, but also very unlikely to happen because, like I said, 2% probability. Nobody is expecting for the Federal Reserve to cut in this upcoming meeting. So this is right now probably the most likely outcome, which is a 98% probability of nothing happening, no cut, no hike, neutral reaction, in my opinion, from the market. Now, really, the market's going to be focused on the summary of economic projections and everything that Jerome Powell says. So again, the speech is going to be very important, the tone, the Q&A, all that, of course, being very important, but the summary of economic projections also incredibly important for the markets here. So if you do see one or more rate hikes penciled in from the Federal Reserve in 2024, that will be very unexpected, because that will basically be going against their December SEP, and that will be very bearish for the market. Now, either that or if we get less than 3 rate cuts in 2024. So the only way I see the market seeing a very bearish reaction to the next week's FOMC is if we get a rate hike expectation, or penciling in a rate hike for 2024 from the FOMC's SEP, or we get less than 3 rate cuts penciled in from the SEP next Wednesday. And that is simply to say that that is a big change in the previous expectations versus what the Federal Reserve is now planning to do. For example, if we get a rate hike expectation, right, penciled into the SEP, very bearish. If we get only 2 rate cuts now penciled in 2024, also very bearish, because that is coming down from the previously anticipated 3 rate cuts, what the Federal Reserve basically told us. So the first one is straight up quantitative tightening. The second one is less quantitative easing. They're both probably going to have a very similar reaction from the market. Now, this right here is what the market's already expecting, 3, maybe 4 rate cuts. It's been kind of fluctuating in between 3 to 4. If the Federal Reserve kind of tells us 3 rate cuts or possibly 4 rate cuts, it's going to be a little bit of an addition from the previous SEP. That could be somewhat neutral to somewhat bullish for the markets, and anything over 5 rate cuts or more, also very, very unexpected and could be very bullish for the markets from that reaction standpoint. So that is where we are with my expectations going into next week. Very, very important meeting, a very critical meeting from the Federal Reserve standpoint, because inflation is showing progress, but at the same time, it is stagnating sideways, still pretty elevated, still staying higher at above 2% target. And really the interest rates, where they're going to go for remainder of this year, is what's going to dictate how the markets react and how they perform remainder of this year. So hope you all enjoyed this video, and let me know your thoughts down in the comment section below, and what do you think and believe from the Federal Reserve standpoint, and what are your expectations? As always, if you enjoyed this video, found it helpful, make sure that you drop a like. Link to our Discord and Patreon is going to be down below if you want to join, of course, to be a part of our MoneyVest community. And as always, happy investing, and I'll see you all in the next video.